Is Lyft the next meme stock being targeted by retail investors? And is Lyft worth investing in right now? Well, let's find out together. Hello, everyone. This is Anthony Grasso bringing you financial news that you can use. In this video, I'm going to do a brief stock analysis on the company Lyft. I'm going to go over a summary of the company, its product offerings, recent headline news of the meme stock status, financials, and its projections, and finally, I'm going to give it my buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. And as always, folks, don't forget to smash that like button down below. Definitely helps. And consider subscribing. Hit that notification bell for like your daily stock reviews and recommendations from an unbiased source. So let's get right into it. So everybody should know what Lyft is, but I'm going to go into their segments. You know, they own and operate multimodal transportation networks in the United States and Canada right now. I think they should expand, right? That offers a variety of transportation options through its platform on your phone and mobile-based applications. The Lyft platform provides a marketplace where drivers are matched with riders via the Lyft app. I have both the Lyft and Uber apps on my phone. Now, transportation options through the company's platform and mobile-based applications are comprised of its ride-sharing marketplace that connects drivers and riders in cities across the United States and Canada. Now, they also have a network of light vehicles, the Express Drive program, where drivers can enter into short-term rental agreements with Flex Drive for a third party for vehicles that's used for ride-sharing services, and Lyft Rentals, which is a consumer offering for users who want to rent a car for a fixed period of time for personal pleasure, and Lyft Driver Centers and Lyft Auto Care, where drivers and riders can request auto maintenance and collision repair service offered through the Lyft platform. But everybody's asking right now, what about this meme stock status? So I'm going to bring up this article real quick from Loop Capital on CNBC. Now, Loop Capital says Lyft could be the next meme stock. Now, I kind of doubt that, but we're going to get into it. They state there's speculation that Lyft could be acquired by a large whale, someone like General Motors, perhaps. Now, this speculation was talked a lot on Twitter and StockTwits, where I get a lot of my news from, of course, what I call the retail army. So if you want to know what the retail army is doing, check out Twitter and StockTwits. You'll read all of it. Now, Lyft has fairly heavy short interest right now of around 12%, 2.6 days to cover, which could invite meme stock dynamics and attempts at manipulation from online forums. But to have stock manipulation, you look for a floundering company. You don't look for a company that's financially good, well, losing money, but they're not going under anytime soon. Now, some investors believe that Lyft could be a strategic acquisition for companies like General Motors, the most logical potential acquirer according to this article. Now, the thesis that Lyft should be viewed as a strategic asset for the reason that developers of autonomous driving technologies. Yes, I do agree, but we're far from autonomous driving anywhere close in the near future. We're years away. Those cars are going to be running over people left and right, led to their own demise. Now, before I go down the road, if it is not a meme stock status coming up, well, let's briefly go over some of the fundamentals of the company and kind of figure out, what's this company all about financially before we just slap a symbol on it and say, oh, meme stock. All right, so going over some of the fundamentals, the stock is currently trading at $18.26 a share. It has a market capitalization of roughly, I think $6.4 billion. So the whale has to dish out some pretty decent cash to get this company. Now, since the company is currently unprofitable, the price to sales and the price to book ratios are the most appropriate valuation measures of this company. Now, when you look at the price to sales ratio versus the industry, it does seem expensive. The industry average is 0.8 times and Lyft is 1.6 times. And but if you look at the price to sales ratio versus its peers, it does seem like a good value because the peers are at 2.9 times price to sales ratio. Now, when you look at the price to sales ratio versus the fair ratio, and that's taking into account the company's forecasted earnings growth, profit margins, and other risk factors, it does seem like a good value because the fair price to sales ratio is 1.8 times and it's currently trading at 1.6 times, so fairly good. And then finally, when you look at the share price versus what I consider the fair value of the company, you're looking at its future cash flows and using the discounted cash flow model, the company's significantly undervalued. When you look at that, I place a fair value at around $84 a share based on its fair value. Now let's look at some profitability numbers of this company. Yes, it's currently unprofitable, and it's definitely not forecast to be profitable over the next 3 years. Maybe in 2024, they have future guidance. They said in second quarter, so the possibility of 2024 being profitable again. Now, based on its gross operating and net margins, the cost structure of Lyft eats up a higher percentage of its revenues than most of the companies in the industry. But to make matters worse, though, the company's losing money on an operating basis. They got to cut their expenses out, and they do have a strategy for that. And looking at the growth rates of this company, although earnings grew over the past 12 months, it took a dip. They failed to keep pace with the growth of revenues. Revenues are going like this, and then earnings are like, and they're going down. They have a lot of expenses. It's becoming less efficient using its resources. However, this result was better than that of the average company in the industry, of course, right now, where earnings fell over the same period. Now, I do think that Lyft needs to fix this major problem of increasing revenues but decreasing earnings, and they need to get a hold on their expenses. And finally, when you look at the financial strength of this company, its total debt to capital ratio is 48%, is in line with the industry's norm despite increasing over the last year. And the company has more cash than total debt, and it does have a very stable cash runway, because this is important to me. How much money do they have on their books to last a couple years before they start digging in and asking for more money by diluting the shares? They have sufficient cash runway for more than 3 years based on its current free cash flow model. And shareholders, though, I have to say, they have been diluted in the past year. Yes, shares have grown by 5.2%. That's an incredible amount to me. But now they have cash runway. They should be able to turn things around, become profitable, because if I look at companies that are going to hit the profitability in the next 2 to 3 years. So that's what I look for when I invest in the companies that have negative earnings. And I look at, how much cash they have, how long can they operate, what is their strategy going forward. So what do the analysts specifically say about this company? Well, let me bring it back over here. Well, currently the analysts say it's a moderate buy, and the analysts put a price target of around $31 a share, right? So am I a buy, hold, or sell recommendation on Lyft and the meme stock status? Here are my thoughts. Now, I want to change tunes and look at their business strategy for a moment, because to invest into a company, you have to look at what's their strategy going forward. It has successfully gained share going head to head against the market leader Uber that we all know of and love. Now, the addressable market that they're in includes taxis, ride sharing, bicycles, scooters. That market has a market valuation of roughly $550 billion based on gross revenue by about 2024 alone. That's a huge market. Now, I feel that the company has a stable model thanks to the interconnectedness around its ride-sharing platform and intangible assets associated with riders, rides, the mapping data, which is very important, which I think can drive Lyft to profitability eventually. Let's hope 2024, and excess returns back on invested capital. Now, but I also have to look at the company's future strategy. Now, they want to become the one-stop shop for on-demand transportation. It has tapped into the bicycle and scooter markets, which is worth roughly, those markets alone, roughly $12 billion by the end of 2029, and that's growing about 7% a year. Now, Lyft also appears to be aggressively pursuing the autonomous vehicle route, as it understands that self-driving cars may help the firm expand its margins. Now, without drivers, it could recognize a bigger chunk of the fare of net revenue. I mean, there could be. But I think we're years away. I think there are going to be a lot of people getting run over by these autonomons. But do remember, we're not there yet. But hey, everybody's going to get there. It's not just going to be one company. It's going to be Uber, Lyft, and Google all getting there at once, I think. Now, Lyft has also gone into the food and transportation and logistics. You can order some Lyft Eats or whatever that is called now. Now, Lyft has in the past mainly focused on consumer transportation, and I think they need more of a revenue diversification in its future. They need to expand out and get and reduce their additional cost of. I think they need to leave United States, not leave, but they need to expand out. Maybe try Europe, overseas somewhere. Don't just stick with United States and Canada. You're limiting yourself on how much revenue potential there is. Now, looking at the second quarter results, though, they reported a stronger second quarter results with top and bottom line figures, but still investors didn't like that, and the stock went down. Good numbers, stock went down. And I was extremely pleased. For the first time ever, the company gave long-term guidance. Now, they laid out a very aggressive 2024 targets. They said that the 2022 revenue estimate is $4.1 billion, which is 28.5% growth year over year. And they said 2023 revenue estimate is $5.07 billion, which will be a 22.9% increase from 2022. Now, average active users, riders in the quarter stood around 19.9 million. That's up 12% and 16% quarter over quarter, sequentially and year over year, respectively. Now, higher demand was also driven by a strong return to leisure and business travel since that pandemic was done. Well, not done, but it's easing. Quantitative easing. All right, so airport rides requested on the platform reached their highest ever and represented 10.2% of total rides, while business rides increased 105% from last year. Now, Lyft's network is evident on the supply side as well. While the firm reduced driver incentives, though, by about 17%, kind of sucks if you're a Lyft driver and being like, hey, I just got cut 17% from a year ago. There's also higher rider demand, which attracted drivers to use both platforms, Uber and Lyft, to say, hey, I just want to get paid. I'm going to use Uber 1 minute. I'm going to use Lyft the next minute. And they increased the driver count to the highest level in 2 years since the pandemic. Now, while I think the demand on the Uber platform also contributed to the Lyft's growth, because if there's higher demand, it's going to bring up both the first and second market leaders across the board. More Lyft, more Uber ride shares. There's going to be more Lyft ride shares as well. Now, before I give my recommendation, now let's examine that meme stock status that article claims it could be the possible next one. Looking at the fundamentals, the company is okay, and it's improving their position and is not in danger of going bankrupt anytime soon. This is definitely not a GameStop or AMC by any stretch of the imagination, or Bed Bath & Beyond. I'm going to do a video on that shortly. Now, speculation of a buyout of the companies that's worth $6.4 billion. That's a nice chunk of change. I don't know if GM would do that, though. Interesting. Well, we'll have to wait and see. I'm not, they're not floundering around by any stretch of the imagination. This is a good company, and they have a good strategy moving forward to get to profitability. And as a long-term investor, I look at the long-term play here. So based on all of that, I am a buy recommendation on Lyft. I put a 12-month price target of $35 a share. Yes, I know we're going into a recession, and that's going to have some effect, but I believe we're going to come out of this with Lyft doing great. Now, I think Lyft is currently undervalued at the moment, and Lyft is attractive balance sheet while I see the free cash flow positive through 2023. Now, I like increasing emphasis on the driving the EBITDA growth, 1 billion goal by 2024, and 700 million free cash flow generation by being more prudent on the expenses of the company. Now, while many people might work from home for an extended period permanently, ongoing travel recovery will support demand from more attractive price to margin airport related rides. Now, there's also a huge push that I've seen in the news by companies forcing individuals to go back into the office. Now, that will definitely benefit Lyft and Uber in the long run. Now, I see growth in revenue per active rider as passengers increase their usage and frequency. There's more rides that come from the premium services, and Lyft offers more transportation offerings. I like recent pricing power, but question the sustainability possibly. Now, there is some risk to this recommendation, of course, in target price. Unforeseen changes in the regulatory landscape, slower than expected ride sharing adoption, which I don't see a slower than expected ride sharing adoption. I think of more adoption. We're not just going to be calling the taxis again. We're going to be going on our phones and be like, I need to get somewhere. Take me now, you know? So there could also be lower than expected revenue per active rider if there's now a pricing war between Uber and Lyft, but you know, I'm not too worried too much about that. And there could be greater than projected insurance costs in the future. And I'm in Florida and we have high insurance rates, extremely high. There's a lot of people uninsured here, or not insured, not uninsured, not insured. But there you have it, folks. And as always, don't forget to smash that like button down below. Definitely helps. And consider subscribing. Slam that notification bell to like your daily stock reviews from an unbiased source. Until the next update video later today, folks. Ciao.